Investing is the act of committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. Investing is important for many reasons, including building wealth, funding retirement, saving for college, and achieving financial independence. Investing can also help to protect against inflation and provide opportunities to grow your money faster than just saving. In this video, we will cover the basics of investing for beginners, including setting investment goals, the types of investments available, building an investment portfolio, investment strategies, risk management, and a conclusion with final thoughts and recommendations. Setting investment goals. A. Types of investment goals. There are two main types of investment goals: income and growth. Income goals aim to generate regular income, while growth goals aim to increase the value of your investment over time. B. Short-term versus long-term goals. Short-term goals have a timeline of 1 year or less, while long-term goals have a timeline of several years or more. Circa SMART goal setting goals that are specific, measurable, achievable, relevant, and time-bound can help you stay focused and on track with your investment strategy. 2. Types of investments. A. Stocks. Definition and explanation. Stocks are shares of ownership in a company that can be bought and sold on stock exchanges. Risks and benefits. Stocks can provide higher returns but also carry higher risks, including the risk of losing money. How to buy and sell. Stocks can be bought and sold through a brokerage account or an online trading platform. B. Bonds. Definition and explanation. Bonds are a type of debt investment where individuals lend money to an entity, such as a corporation or government, in exchange for interest payments and the return of the principal at maturity. Risks and benefits. Bonds are generally less risky than stocks, as they provide a fixed income stream and have a lower volatility. However, they also offer lower returns compared to stocks. How to buy and sell. Bonds can be bought and sold through a brokerage account or directly from the issuer. 3. Building an investment portfolio. A. Diversification. Diversification is the practice of spreading your investments across different asset classes, such as stocks, bonds, and real estate, to minimize risk. B. Asset allocation. Asset allocation is the process of dividing your investments among different asset classes based on your investment goals and risk tolerance. C. Rebalancing. Rebalancing is the process of adjusting your investment portfolio periodically to maintain your desired asset allocation. IV. Investment strategies. A. Dollar cost averaging. Dollar cost averaging is an investment strategy in which you invest a fixed amount of money at regular intervals over time, regardless of market fluctuations. B. Buy and hold. Buy and hold is an investment strategy in which you buy stocks or other securities and hold onto them for the long term, ignoring short-term fluctuations in the market. C. Value investing. Value investing is an investment strategy in which you seek out undervalued stocks or securities and invest in them with the expectation that their value will eventually increase. D. Growth investing. Growth investing is an investment strategy in which you invest in stocks or securities with high growth potential, even if they are currently overvalued. Versus risk management. A. Definition of risk. When you invest, you expose yourself to various types of risks that can affect the performance of your investments. Risk can be defined as the possibility of losing some or all of your invested money. B. Types of risk. There are many types of risks involved in investing, such as market risk, inflation risk, interest rate risk, credit risk, liquidity risk, and more. Understanding these risks and how to manage them is crucial to building a successful investment portfolio. C. Risk tolerance. Your risk tolerance is your ability and willingness to take on risk when investing. It is affected by factors such as your age, income, financial goals, and personality. Understanding your risk tolerance is important for creating an investment strategy that aligns with your goals and preferences. D. Managing risk. There are many strategies you can use to manage risk when investing, such as diversification, asset allocation, and rebalancing. It's important to regularly review and adjust your investment portfolio to ensure that it continues to meet your goals and risk tolerance. V. Conclusion. A. Recap of key points. Investing can be a powerful tool for achieving your financial goals, but it's important to approach it with a solid understanding of the basics. In this video, we've covered the definition of investing, the importance of setting investment goals, the types of investments available, how to build an investment portfolio, investment strategies, and risk management. B. Final thoughts and recommendations. Remember that investing is a long-term game, and it's important to stay disciplined and patient even when the market is volatile. If you're just starting out, consider seeking the help of a financial advisor to guide you through the process and ensure that your investment strategy aligns with your goals and risk tolerance. If you found this video helpful, please give it a thumbs up and share it with others who might benefit from it. And don't forget to subscribe to our channel for more personal finance and investing videos. Thank you for watching this video on investing for beginners. We hope you found it informative and useful.